we are very happy to have you all here. I must say that this year of 2011, we are commemorating the 50th anniversary of something started in 61 at the beginning under the leadership of Professor Vargas. And the whole year of 2011, we are celebrating this, which I would say a great achievement, a great institutional achievement. To have an institution which nowadays we are happy to rank for the Tilburg ranking at first in Latin America. And I think that one of the reasons that we have reached this position is exactly by doing what we're going to do today. To have among us people, today very special people, to share with us their knowledge and their thoughts about what's going on in terms of science, in terms of politics, in terms of policies, and in many different dimensions. I'd like to thank Professor Castelo Branco, who was the first PhD of our school. When did you get the
1977, September 1977.
And
just
30 something years ago, and who also is our sponsor to this meeting through the Companhia Vale. And so today we are going to have the great honor of having with us Professor Robert Engle, Nobel laureate 2003, who is also the director of the Volatility Institute at the University of New York. So I will not take your time anymore because we are here to listen to Professor Engle. So Professor Engle, please, you have the floor.
Thank you. Thank you very much, Professor. It is a great pleasure to be here. I have been fortunate to visit Getulio Vargas a couple of times in the past, and it's great to help celebrate this 50th anniversary. Today I'd like to talk to you about the financial crisis, and I guess I'm thinking about this as the question of whether it's a future financial crisis that we're talking about or just the past one. I'd like to talk about how do we avoid having another financial crisis? And this is a question that we would all love to have the answer to, and it's a sort of a provocative title because I'm not going to give you all the answers as to how to avoid a future financial crisis, but I'd like you to think about it that way. Because we're all faced with exactly that problem. We are trying to figure out how do we adjust our financial institutions, how do we adjust our regulatory and our political institutions to make the chances of another global financial crisis smaller than they were before. At New York University, the Stern School of Business, we have spent a lot of time studying the financial crisis. In fact, we wrote a book in a relatively unusual way. We got 30 faculty together and said, what do you think about the financial crisis? And we ended up writing in about 6 weeks a book which many people think is one of the best from an economics point of view descriptions of the financial crisis, which we published in, I think, 2009. That was very interesting and very successful. We then wrote a second book describing our view of the financial regulation that passed in the US called the Dodd-Frank bill. and giving an assessment of different aspects of this bill. So that we've spent a lot of time talking about the financial crisis, writing about it, and doing research on it. So what do we learn from all this work? Well, there are some lessons that we think are quite important from the financial crisis. And one of the important ones that I want to focus on today is the fact that the failure of large, complex financial institutions can have a devastating effect on the total real economy. We saw this in particular with Lehman, but also with many of the other institutions that either failed, like, or were purchased, like Merrill Lynch or Bear Stearns, or that failed, like Washington Mutual and Wachovia, but still others which are alive but only on government support, like Citibank and Bank of America. So these institutions have played a very important role in the financial crisis. And the question of whether the government should rescue such financial institutions is very politically charged. If they do rescue financial institutions, then the next time financial institutions will expect a rescue and take on excessive risks. If they don't rescue financial institutions, and there has been some substantial criticism for not having rescued Lehman Brothers, we get the financial crisis that we've just been through. So the question is there another choice between rescuing and non-rescuing financial institution? And the choice is what I really want to talk about today. The choice is to regulate these institutions so they do not come as close to so they don't need to be bailed out. Can we regulate financial institutions and achieve a more socially optimal financial system? So I would call this identifying systemic risk. Can we identify the institutions that we want to regulate so that we can prevent them from needing a bailout? And I'm going to, first of all, show you in pictures what I mean by systemic risk. In fact, this is a picture of a chimpanzee who is taking a great deal of risk. He's standing in the top of a tree. It's a very tall tree. He's reaching out to catch insects, and he's going to eat these insects. But of course, the further he reaches out, the better he's going to do at catching the insects, and the more he's going to feed himself. And yet, if he reaches out too far, he's likely to fall out of the tree. He's going to have to step out on those smaller and smaller branches. And do we worry about the risk that this chimpanzee is taking? From a social point of view, is this risk that we need to pay attention to? Well, my view is no, that this is not a social problem. This is a risk exactly like we talk about in finance classes. The more risk he takes, the more reward he gets from catching more food, but ultimately he may fall out of the tree. But as he falls out of the tree once or maybe twice, he will certainly learn which branches are strong enough and which are not. There is a natural trade-off between risk and return that he's facing and in his hunting for these insects. So this is what we call individual risk. And it should be contrasted with systemic risk. So what do we mean by systemic risk? So let me show you another picture. Well, it kind of looks like the first one, doesn't it? But I'm going to give you a new piece of information. This turns out to be the last male chimpanzee. So now, when you think about the risk that he's taking, it's a risk to society. In fact, when the town council gets together, I guess all women on this town council, when the town council gets together, they worry about him taking too much risk. And so they might pass some resolutions. For example, they might hire government workers to go stand under the tree with a tarp to catch him. But we see immediately that this will encourage him to take more risk because he could be caught if he falls out of the tree. So that's not necessarily a very general solution. Another thing they might do would be to tie a rope around him and tie it to the tree so that he can't reach out very far. But if the rope is too short and too strong, of course, he will not be able to feed himself and he'll die anyway. So what's required is some sort of a system that allows him to feed himself without taking the most extreme risks. And that's the regulatory challenge that we face today. And we face it within countries like the US, but we face it more generally globally. We need to have a regulatory environment which doesn't penalize financial institutions, but restricts the amount of risk that they can take insofar as that risk is endangering the global economy. So you might say, well, that's good. How do we do that? And that's what we want to talk about. From an economic point of view, here is a more natural definition than my pictures. This is a Federal Reserve Governor Daniel Tarullo's definition of risk, and he says that he thinks financial institutions are systemically important if the failure of the firm to meet its obligations to creditors and customers. So notice it's the failure of the firm to meet obligations. So we're talking about something like bankruptcy or severe stress so that contracts are broken. If it fails to meet obligations to creditors and customers, that this would have significant adverse consequences for the financial system and the broader economy. So systemic risk is a failure of an institution to meet its obligations that has consequences to the real economy. Which firms are most likely to fail are firms that take a lot of risk, and we can think about these as firms that take a lot of leverage. In other words, they borrow a great deal and they invest the proceeds so that the risks become greater and greater the more leverage these institutions take. But there's an added factor that we think is quite important, and that is that if a financial institution fails when the rest of the economy is strong, it has very minor effects on the economy because there are other institutions that can buy the troubled institution, and we see that happen all the time. We have lots of examples of banks like Barings or ABN AMRO or so forth that have failed but are purchased by the rest of the financial sector. So if a bank fails just when other banks are weak, then there are no purchasers. And so we think that firms that are considered systemically risky are firms that are likely to be in trouble at the same time the financial sector as a whole is in trouble. And that changes our notion of risk from individual risk to societal risk. Another way of saying this is that we think that high leverage is dangerous only when many institutions are taking high leverage. In other words, high leverage is dangerous when everyone is doing it. And this is what we mean by an externality. That it's not just individual's choice, it's the individual's choice in this they contribute to the social risk. And this is why we need regulation. So this is developed in a more theoretical context in Acharya, Pedersen, Philippon, and Richardson, four of my colleagues. And they suggest ways to use publicly available market data to evaluate the financial systemic risk of individual firms. And what I'm going to show you is an econometric implementation of this, which is in a paper by Christian Brownlees and myself, which uses time series methodology to try to put this idea on a firm footing. So we like to phrase the question a little bit differently. How much capital would a firm need if we have another financial crisis? In other words, if we have a financial crisis, then financial institutions are going to have reduced profits, reduced equity values, probably. And if this reduced capital makes them so close to being bankrupt, or perhaps bankrupt, they will need to raise capital. Can you raise capital in that kind of environment? Well, it's difficult to do. The natural source of capital might be the taxpayer or government. And so the question is, how much would this bank come to the government and say, you know, in order to survive, I need $100 billion. I need $50 billion. I need $1 trillion. What is the number that they would come to? And of course, the government might or might not decide to do this, but this is our measure of how much systemic risk a financial institution has. How much capital would they need from either the government or some private sector if we have a financial crisis? So the idea is quite similar to a stress test, and financial regulators have been doing stress tests for a long time, and we could ask and the way financial regulators do this is they pose a scenario, and then they go ask the financial institution to implement this scenario on their books to see how much capital they would have at the end of this scenario. So things like, suppose 30% of your mortgages go into foreclosure, and supposing interest rates fall to 1%, and suppose the stock price goes down by a certain amount, a whole bunch of different assumptions. They can then calculate what kind of stress the company would be under. They do this by evaluating the effectiveness of all the different lines of business that this company is in. It's a very complicated task with lots of assumptions. We are going to do the same task, but we're going to rely on market valuations of these same industries rather than regulators' valuations. That is, we're going to propose what sometimes might be called a top-down approach. That is, let investors evaluate this company and then see, with that kind of evaluation, what kind of capital buffer the company really has. So we could think about this as asking the question, how much capital would a company need if there is a crisis? But what we really want to know is, which companies cause the crisis? Is this the same question? Does the crisis cause the firm distress, or does the distress cause the crisis? And the answer is both. From an econometric point of view, the crisis and the distress are jointly endogenous variables. And when we ask, how much distress will there be if there's a crisis, that's asking what's the value of one endogenous variable given that there's another endogenous variable. But the fact is, unless firms are stressed, there won't be a crisis. And therefore, we are answering the question of which firms are going to contribute the most to the crisis. In other words, if we add up the capital that's needed by all the firms by our estimates in the crisis, we will then have the total amount of capital that the economy is short at this point in time. And that is contributed exactly by these same firms. So these are the firms that are contributing the most to the financial crisis. So I want you to realize that even though I'm asking the question, would a crisis affect the amount of capital this firm would need, I'm also asking, is this firm, by being weak, contributing to the future financial crisis? So you could think about this, the firm, as maximizing something. A financial institution has some demand deposits, it has some equity value, and then it borrows. And then it uses all of these assets to buy positions. Some of these might be loans, some of them might be investments and other things. And so you can think about this bottom line as sort of the budget constraint for a financial institution. We have net wealth plus borrowing plus guaranteed deposits, demand deposits, is equal to the sum of the investments that the firm makes in a period. So this is a two-period model, and it's only going to take 2 slides, so that's good. So in the second slide, the second period happens, and each of these investments pays off. Some of them pay off well, some of them pay off badly. Some of them might be short investments where you're borrowing money and short, and you would find out how much you actually had to pay for that money you borrowed. So that gives you the wealth in period 2, except for one additional factor, which is if the firm has actually invested badly and borrowed too much, it may face bankruptcy and would have additional costs due to bankruptcy charges. That's this Y figure on there, and that might send the wealth of the investors in this company negative. So it's quite possible that this firm took so much risk and so much leverage that it became bankrupt and its net worth went negative. In this case, it either goes through the normal bankruptcy procedures, or it asks for capital from the government, or tries to raise capital. If it's really insolvent, it's going to have a hard time raising capital. If it's just illiquid, it might be able to raise capital, but that's the task it's going to have. So the firm is going to choose how much risk to take based on this threat that it will go bankrupt if it takes on too much risk. And so this is the risk management tool that many economists are involved in. How much risk is actually involved in taking these amounts of making these investments? And when volatility is low, such as it was from 2003 to 2007, actually, the first part of 2007, it doesn't look so risky to take a lot of leverage, because your returns won't be very likely to be extremely negative. They're likely to have a small dispersion. Covariances and variances are likely to make it look like it's not very risky to take a lot of leverage. And so one of the things that happened between 2003 and 2007 is financial institutions increased their leverage. They borrowed more. They looked actively for additional sources of revenue, but that meant additional sources of risk. This is where subprime mortgages really became such an important investment, because it was another source of risk that firms could take, and they paid pretty well. But the value of these were all calculated using measures of risk which were pretty short term. They didn't include the possibilities that we eventually saw. And so we could think about this partly as a problem with risk management, that the firms took too much risk because they didn't recognize that this low volatility period wasn't going to last forever, and that the risks were going to increase. It's likely to increase sometime in the future. So this is a perfect scenario for regulation. If bankruptcy is socially costly, and for the financial sector it's very socially costly, then we would find it sensible as economists to regulate the institutions so they would not take such great risks, because the risks they're taking are not just individual risks, they're system risks. So how are we going to build an econometric model of this? The approach we're going to use is we're going to try to estimate what the capital shortfall of the firm would be if there's a financial crisis. This is hard to do because we don't have very many financial crises. If we're going to do econometrics, we have to build a model using data which is not just from a crisis period. So we're going to estimate something called the marginal expected shortfall, which is the expected loss that an equity holder would find in a particular institution on a day when financial markets have substantial declines. So this is a one-day measure of loss. It's a loss that investors in one company would feel if the market declines on that day. We're going to take this one-day loss and extrapolate it. Economists hate extrapolation, but that's just what we're going to do. We're going to extrapolate it to the losses that an equity holder would face if there's a full financial crisis. And then we're going to calculate how much capital this firm would be short if its equity values fall that much. So we can think about a financial crisis as being a 40% decline, for example, in aggregate stock market valuations. How much would a financial institution go down? Maybe 50%. We would be trying to estimate that. If their equity goes down by 50% and bonds and the debt stays the same, this institution is going to find its leverage is going up and its risk is going up. And that's the way we're going to calculate this. So what we need to estimate is, first of all, the relationship between the stock market as a whole and each individual financial institution. And so that's a bunch of little bivariate problems. So for example, here is a model for the stock market return, which is written as a product of two things. One is the volatility of the stock market, and the other is the surprise in the stock market. And the surprise is a mean zero, variance one, random variable. The second equation is the return on an individual firm's equity. And that is written as its volatility times its surprise. But its surprise may be correlated with the market as a whole. And in fact, the correlation is estimated here with this parameter rho, but this parameter rho is allowed to change over time, suggesting that the correlation is changing over time. So we have two parts. One is the part that's the same as the market, and another part is uncorrelated with the market. So it's idiosyncratic in the market part. So we have two volatilities and one correlation to estimate, and we're going to use Garch models for the volatilities. We'll use asymmetric Garch models, and we're going to use a DCC model for the correlations. Now, some of you may know what Garch and DCC models are, and some of you may not, but they're basically simple pretty intuitive time series ways to every day come up with your best estimate of what the volatility is and what the correlation is for this company. And I'll show you pictures of how they work. And with this information, we can calculate what the marginal expected shortfall is. In fact, we can substitute in this equation the definition of marginal expected shortfall as the expected value of the equity holder's return on a day when the market falls by a certain amount C. And so if you substitute in, looks like the pale green is not going to be too easy to see, but if you substitute in, the thing I most want you to see is these first two numbers. What you get is a product of the volatility of each firm, which is a way of measuring its individual risk, and the correlation between that firm and the market as a whole, which is what makes it a systemic risk. So I said we're wanting to know whether firms take on risks that are correlated with the rest of the financial institutions, so they will be in trouble at the same time other institutions are in trouble. That's why this shows up as a product of volatility times correlations. There's a second term out here. Well, the green term is the same for all firms, so it doesn't change across firms. On the right-hand side, I have a term which actually would be zero if these are really normally distributed random variables. But if the individual specific error and the market specific error are both big at the same time, we have something called tail dependence, and that term could be important. But at least for the first round of thinking about it, you might ignore that. So that's the econometrics. Wasn't too bad, right? So what we do is we do a time series model for each of about 100 financial institutions in the US. Bivariate between that and the market return. We calculate this marginal expected shortfall, and we're going to then do this extrapolation and calculation steps to calculate the systemic risk. So, how do you know whether you did a good job or not? Well, we could wait till the next financial crisis and see if we identified the firms that got in the most trouble, but I hope we can do something before that to see whether we've done a good job of measuring this. So what I'm going to do is, first of all, show you tests of whether the marginal expected shortfall works fairly well in predicting which companies are going to have big declines on a day when the market goes down. So on here, I have a picture of the probability that the market will decline by 2% every day. This is a prediction. And you probably should notice that on the right-hand side, it's a logarithmic scale. So in the financial crisis, this goes up to more than 25% probability of a 2% market decline. It probably can't go over 50% because it's not only declines, it's not increases. So this is extremely high, but it doesn't show so much on the scale. And then you see back here, before 1907, the probability is less than 1/10% of a 2% decline. And on the bottom are all the days where we had a 2% decline. And so on each of those days, we can see how well our predictions turned out. We can look whether these 100 companies, which one of these companies did the worst? Which ones did the least badly on a day when the market went down? It's a little bit like the beta of a stock, but it's changing every day. So we're going to compare our GARCH DCC approach to some historical measures using, for example, rolling 4-year windows of returns on 2% down days, And then we're going to use a sort of a static beta model where we look at a CAP-M type model where the beta evolves gradually with the 4-year rolling window, much like a lot of the asset pricing literature does. And if we do those, we can compare the predictions of these 3 approaches. We can compare them, first of all, by looking at, on each of these days when we had a 2% decline, we can look at the root mean squared error percentage difference between the losses that are predicted for this firm and the losses that actually happen for this firm. And if we look at that, that will give us a measure of which method is the best at predicting which firms are going to lose the most. We can also look at the average across firms, that is, what is the average MES and what are the average losses on this 2% down day. And thirdly, we can look at the rank correlation between the losses and the predicted MES. That is, if we rank the firms from 1 to 100 based on our prediction, and we rank them 1 to 100 based on how they did, will those rankings be the same? What's the correlation between those rankings? Okay. So in any case, in short, there is a big improvement. This root mean squared error is much smaller than either the historical or the static factor model. The root mean square error on the average is much smaller than these averages. The correlation is a little bit higher than these 2 models, but not a lot higher. So that these other approaches get the companies ordered fairly well, but they don't have the magnitude very well estimated. Okay. Just a word on the extrapolation step. What we'd like to do would be to simulate each bivariate model out 6 months, look at which of these simulations correspond to a 40% decline in market equity values, and then what would happen to this firm. And that is going to be the long-run version of the marginal expected shortfall. That's given in this bottom equation here. In fact, what I'm going to show you today is not that, it's an approximation to that. This expression turns out to be approximately equal to 18 times the short-term marginal expected shortfall. And the use of this approximation doesn't change the effects across firms. We're using the same 18 for all firms. So the rankings are going to be basically preserved by this, although it's not as accurate and it doesn't reflect some features of the market the way this expression does. And we have a paper which does this, but we don't have it yet on the website that I'm going to show you. So finally, we have to calculate how much capital is going to be lost. Essentially, we define something called S-risk. And the S-risk is the difference between some amount of capital, K, times the debt, and 1 minus K times what the equity will end up being. So if you think that a firm should have 8% of its assets in equity, or more, then whenever it drops below that, the company is going to need capital, and whenever it's above that, the company won't need capital. So 8% is approximately one of the numbers that the BIS is proposing for capital regulation. And so we can think about that as a starting point. So the debt is the nominal amount of debt, the nominal face value of the debt as reported in filings with the SEC, and actually is constant for a quarter at a time, but the equity changes every day, so that this measure of risk changes every day. So we have taken this model, sort of complicated, not very complicated, but a little bit complicated model, and implemented it in a web structure that you can see from here. This is the web address. It's called VLab, which is the Volatility Laboratory, which is hosted by the Volatility Institute, .stern.nyu.edu, or systemicrankings.stern.nyu.edu. And this gets updated every week so that you can see which companies are viewed as most systemically risky and why they're systemically risky. What's the correlation? What's the volatility? What's the MES? What's their leverage? And so forth. So let me just show you some pictures from this website. And I hope I'll whet your interest to go and look at it. And if there's some news story, maybe you'll go look at it again to see how this changed the rankings. So here is Citigroup. So this is the marginal expected shortfall of Citigroup. It's shown in red. And this is from September of '09 to more or less 2 days ago, I think. I think I did this in Buzios, so probably 2 days ago. And you see, it does jump around quite a lot. And we're asking, how much would an investor in Citigroup lose on a day when the market goes down by 2%? And so here's 2%. So for all these days, a Citigroup investor would lose more than somebody who was invested in the broad equity index, S&P equity index. And that's true of the average. Blue is the average of all of these financial institutions. But one of the things you should see is, look at what's happened at the end here. We have this MES spiking up over the last 2 weeks. And one of the reasons it's good to have this on a regularly updated basis is we have had a very high amount of volatility over the last few weeks, in case you haven't noticed. And stock markets all over the world have been jumping around. And the question is, what's happened to the risk of owning Citibank stock? And the answer is, it's gone up a lot. So let's take a look at the pieces of this. So here's what happened to the correlation. The correlation has gone up to a little more than 80% between Citi and the broad S&P index. But actually, it was around 70 or 60% for most of the last couple of years. In fact, by the way, I should say that this data extends back further. This is just the part of it that I'm showing you. So there is some increase in correlation relative to the average financial institution, but more, it looks like all financial institutions have increased the correlation with the S&P during this last month of turbulence. Why is that? It's a good question, isn't it? Why is that? Well, I think that financial institutions look like they're more vulnerable to the kinds of political pressures that are likely to come if the economy has a double-dip recession and the kinds of things that we're worried about. So the dramatic thing is what's happened to volatility. You can see financial institutions as a whole have volatility that's gone from about 40% up to more than 80%, but Citi went up to 130%. So investors in Citi stock saw very high volatility. What's happened to the leverage? Well, because Citi's stock went down in value, its leverage went up from maybe 15 to 1 to something like 23 to 1 or something like that. So not nearly as high as it got to during the financial crisis when it was well over 100, but still an increase in leverage and therefore in risk. And finally, what about the S risk? That's a measure of the systemic risk contribution of Citibank. Right? This is plugging into this formula here and multiplying by 18. You can see this is measured in billions of dollars, and it looks like at the peak over the last month, Citi was predicted to need if this thing is extrapolated out into another crisis, almost 200 billion of capital from the government to keep its capital ratio at 8%. So, Citi, because it's still a weak financial institution, had its volatility shoot up in this event, had its measure of systemic risk shoot up, and actually, probably because Citi and Bank of America are still weak, the whole financial sector looks weak and probably made the volatility higher than it would otherwise have been. All right, so what can we expect? Well, maybe this is the answer, or maybe this is the answer. So can we solve this problem and get Barack dancing with Sarah Palin? Okay, well, here is what our website currently shows as the top 10 systemically risky financial institutions. Bank of America is number 1. It's 16% of the risk. Citigroup is number 2. It's 15. Then we have JP Morgan Chase, Wells Fargo, Morgan Stanley, MetLife, Goldman, Prudential, AIG, and Hartford Financial Services. But you can see that 17% and Hartford is 2%. So the amount of capital involved for some of these lower ranked firms is not nearly as great as it is for the top 2 or maybe 3. If you want to see more detail, you go to the second page of the website, and this ranks all 100 of these firms. So here are the top 10 actually. This is the ranking as of May 13th, and there's a little down arrow here which allows you to choose the date you want to see the ranking on. So here we see that it's similar, although not exactly the same, a couple months ago. Here's the S-risk, MES, beta, correlation, volatility, leverage, and market value, which is the market cap. So this is interesting. But you might wonder, these are biggest companies at the top. Supposing we just sorted them all by size, wouldn't that be the same? Am I doing anything more than that? And the answer is, if you click on the top of this column, you'll immediately get them sorted by size. And here's what you'd see. You'd find that Berkshire Hathaway was actually the largest institution, and therefore you might think the most systemically risky. However, according to according to our data, he was number 77 on the list. Now, many of these others are on the top, but not in the same order. JP Morgan Chase is bigger than Wells Fargo, which is bigger than Citi and Bank of America. And then we've got companies like American Express and United Health and US Bancorp on the size list, but not on the systemic risk list. What about sorting by MES itself? It turns out the largest MES is C.D. Richard Ellis Group. That's a real estate firm. And then you have NBIA, which is an almost bankrupt mortgage insurer. And then the Morgan Stanley is the only one from our top 10 list that makes the top of the group. And then there are a lot of high MES firms that are not considered to be high systemic risk. And finally, if we look just by leverage, you can see we're still not telling the full story, because some of these are in the top 10, but quite a few of the high leverage firms are not in the top 10. So the point is that the ranking that we've proposed here is not the same as simple measures like size and leverage. It combines them in a relatively simple but useful way. So, does this work? Well, we could only we looked at MES to see if that worked, and that seemed to work. But does this predict what's going to happen in a future financial crisis, it's pretty hard to know how to do that. So instead, we're going to look at past performance to see what it looks like. And I'm going to sort of flash through this because there are kind of a lot of tables here, and I want to talk a little bit about regulation and Brazil. So let me just kind of zap this. So here's what it looked like before the financial crisis started. We have Morgan Stanley, Merrill Lynch, Goldman Sachs, Fannie Mae, Freddie Mac, Citi, Lehman, JP Morgan, and Bear Stearns, and MetLife on the top 10. Notice, a lot of those companies don't exist anymore. I'm not sure how familiar you are with U.S. financial institutions, but about half of those are gone. And 8 of the top 10 were very much in the financial crisis. And so it's a pretty good list in terms of who we should worry about going forward. The two most notable companies that are missing are AIG and Bank of America. Bank of America is down here, number 17. But one of the things Bank of America did was they bought Countrywide, which is a bank which was writing subprime mortgage insurance. Here's Countrywide. And when Bank of America bought Countrywide, if you want to move up the football tables, you can either train prospects through the system, or you can buy the ones that are already developed. Well, Bank of America managed to leap to the top of this list by buying a risky financial institution, Citibank. And so here's Bank of America. It was 87 before the financial crisis, jumped to number 11 in January of 08, and it's been number 1 ever since. If you look at AIG, which was also missing from there, you see that they were originally number 91, then they jumped up to 4th, 5th, and are currently, this table is done, in 8th place. If you look before Bear Stearns, you see this listing, which has Bear Stearns not as number 1, it's number 12. So if it's number 12, maybe it doesn't need to be rescued, maybe it did. The Fed did engineer a buyout with JP Morgan, but they had to pay some money for that. How much did they pay? You might not remember, but the number was 30 billion. They bought 30 billion of toxic assets from Bear Stearns that JP Morgan didn't want, which is, I think, coincidentally, the same number that we've got on here. If you look before the Freddie and Fannie and Lehman and AIG, you see which institutions were high on this list. We have Bank of America, Citigroup on the top. AIG was number 4, and they got rescued. Merrill Lynch was bought, number 5. Fannie and Freddie were rescued, they were 7 and 8. Wachovia went bankrupt. Lehman Brothers was not rescued at number 11. And again, with all these problems at the top of the table, maybe it's not surprised that Lehman was let go. The Fed also did a stress test in the spring of 09, so we can compare our results with the Fed results. And they're actually pretty similar. They came up with Bank of America top of the list, Wells Fargo second, GMAC, which is not publicly listed, third, Citigroup fourth. We have Bank of America, JP Morgan, Wells Fargo, and Citigroup as our top 4. They're pretty similar, except that we have JP Morgan Chase up here, and JP Morgan Chase is viewed as not risky at all in this Fed analysis. And so that raises an interesting question about, is JP Morgan Chase really systemically risky or not? And from private conversation with regulators, they said, don't change your rankings. But we could talk about that if you want. Anyway, here's what capital systemic shortfall looks like, aggregate. It was low before the crisis. It went up dramatically during the crisis. It's come down now, but it's not as low as it was before the crisis, which says that a systemic event is still a risk. The probability of a crisis has been changing over time. It now is estimated at about 1%. Looking forward, this is before the most recent episode. It would probably have gone up, but that says starting from today or starting from 4 or 5 months ago, what would be the probability of getting another 6-month period which looked like this financial crisis? The answer, according to this, would have been 1%, 1 out of 100 times. All right, so now, how do we use this information, if we believe it, to regulate? So one thing you might want to do is say, what we'd like to do is make sure a firm doesn't have any capital shortage in a crisis. How much capital would they have to hold today in order to make sure when the crisis hits, they don't have a capital shortfall? So if what we mean by a capital shortfall is they have at least little k of capital, then what would they have to have today? So we would like the equity to be greater than or equal to big K times debt plus equity, which is the value of the firm today. And we would also like the equity after the collapse in a crisis to be greater than or equal to little k times the same debt plus the drop in equity. So that tells us that big K should look like little k with this correction factor in the denominator. What that tells us is that firms that are taking more risk are going to have a bigger NES and therefore will need more capital today. So, for example, you probably heard that Basel Committee has recommended maybe a 7% capital ratio for firms. But individual regulators have said, we want more than that. We're going to want 10%, or we want 12%, or something like that. What this says is that individual firms should have different capital requirements depending on how much risk they're taking. If you want to take a lot of risk, your regulator is going to tell you to hold more capital. And that makes a lot of sense, seems to me anyway. So this is a formula that tells you how much it would be. And so if little k is 8% maybe, then big K, and long run NESs, maybe 50%, then this would be 8% over 1 minus 50%, so it would be 8% would go up to 16% if the long run NES is 50%. If it's only 40%, it would go up less. Another way accountants do this is they do risk weighting. So you could think of the assets using this long run little k. You could think of the assets as being not just debt plus equity, but debt plus equity multiplied by 1 over 1 minus k times the long run MES. So the more risk the assets take, the bigger the asset base on which you're going to have to hold capital. So this is like the way Basel Committee does its risk weighting. So a firm that doesn't like holding as much capital as it's being asked to hold has some choices. It can reduce its leverage. That's going to immediately reduce its capital requirement. It can reduce its size. It can reduce its risk and reduce its correlation. These are all possibilities that a firm could have to reduce its capital requirements. Another aspect of the Basel Committee is that they would like, and this I think is important for Brazil, they would like these requirements to be countercyclical. So in other words, when conditions get better, do you have to hold more capital or less capital? By what I've just shown you, you actually have to hold less capital because you already have a decline in your leverage and you need less capital to avoid the S risk. But this doesn't give you a capital cushion. So Spain introduced what they call dynamic provisioning, which says when things are going well, you should increase capital requirements so that you have a bigger buffer in case for the day when things go badly. And when things start going badly, you should reduce the capital buffer so that the financial institution is able to make loans and keep the financial system going. So the idea is, how can you do a counter-cyclical version of this policy? And I don't think I know how to do this, but I think this is a key issue and actually something I'm thinking a lot about. One of the things I wanted to show you is what I thought about it in Bucios, which is, suppose instead of thinking of a financial would actually increase more and more. So the reason I say this is potentially interesting from the Brazilian point of view, when the economy is strong and doing well, the question is, what do you want to hold your capital against? Do you want to hold capital against a 40% decline in the equity market? Maybe. But maybe what you want to do is hold capital against a return to some more ordinary level of the Brazilian economy. In other words, the drop that you could imagine when the real is very high could be very great, in which case you would want your financial institutions to have a bigger cushion. And this might also be true of individual households, it might be true of individual firms, that the higher the economy goes, the bigger cushion you might want to hold against what could eventually unravel as the economy, if the economy collapses. I think when you look at some of the performances of the Eastern European countries during the financial crisis, they took advantage of the strong currency to borrow a great deal. Certainly that was true of countries like Iceland, that borrowed an enormous amount, and Ireland borrowed an enormous amount. Greece borrowed an enormous amount. And then when the economies turned, these debts came due, and that was the problem. So if you had a model with this kind of counter-cyclical, this counter-cyclical provisioning, you would be much better protected against a future financial crisis. So I think what I've just said is what's on here. So if you have a lot of capital inflows into an emerging market, you would expect that borrowing is cheap and investment opportunities are very good. This encourages you to borrow a lot and invest a lot. That is taking a lot of leverage. And whether it's financial institutions or individuals, it's the same problem. Probably not surprisingly, many of these institutions would all be doing the same thing. So their results would be very highly correlated. And if some of these, if the rise in the real stops, probably that's going to affect many institutions in the same way. And so I think it's sensible of regulation to try to offset these incentives to borrow and invest for higher returns. I should point out that this looks like a good deal, borrowing cheaply and investing with high returns, but what kind of risk measure do we want to put on this? And if we use short-run risk measures, it may look like it's not very risky. But if we use longer-run risk measures that have to do with where the economy really might be in a year or 2 years or something like that, it may look considerably riskier and would be an argument that a risk manager should make to keep the leverage and the exposure from getting out of control. So I think from a regulatory point of view, regulators should offset the incentives to take on leverage. My understanding is the regulators have been really quite conservative in Brazil, and I think that's probably an advantage that the Brazilian economy has, that the financial institutions are really quite robust, if not even protected in their economic environment. But from an individual point of view, there's no regulator that's going to tell you what to do. But if you think about the long-run risks in the right way, I think maybe it will help you understand which of these risks make sense to take and which don't make sense to take. So let me stop here. I've shown you a methodology using only public information, assuming firm equity prices really reflect the value of the firms. Historical rankings are pretty reasonable. Obviously, we can improve the model. I don't see that this is an alternative to prudential supervision. It's really a supplement to it and helps figure out which companies to look at. And hopefully, with wise regulation, you'll be able to reduce the risk of systemic financial institutions without actually curtailing their business so much that they can't function. So let me stop here and invite you to the Arch Cafe. Thank you.
Thank you, Professor Engle. So now we are going to have time for questions from the audience. I'd ask those who are going to make questions to please identify themselves and speak at the microphone and, if possible, loudly, because we have difficulty to hear from the table. So there are 2 persons holding microphones there. Before somebody gets the microphone, let me just, since we are commemorating once more our anniversary, to register and to thank the presence here of 2 of our former directors, Professor Clóvis de Faro, who is taking his place here, and Professor Renato Fragelli. Without their work, we would not be here right now. So just wanted to mention that. First question.
Yes, hi, I'm Leandro from BDN Bank. I'd like to ask you a question on European banks. Is it possible to do the same exercise with European banks? And how could you include sovereign risks in this analysis? Thanks.
It's clearly possible to do this for European banks, and Latin American banks, and Asian banks. We've recently formed a partnership with slide I skipped with Université de Lausanne in Switzerland and the University of New South Wales in Australia to do this globally. And we've actually made, we have a big grant from the Sloan Foundation, and we've actually made some progress. We have some preliminary results, and although these were from a couple of months ago, and it looked like there were quite a few European banks that were more risky now than they were during the financial crisis. And I think that there is a big concern there. The same thing is actually true of Japanese banks. But very little evidence of systemic risk in many other parts of the world that we look at. So why is that? Well, I think you're right that it's the sovereign debt crisis that's really impacted a lot of the European banks, and even though they're unwilling to mark down some of these sovereign securities, I think the market is marking them down, and that's the reason bank stocks have been hit very hard in Europe. So the second part of your question is, could we do the same thing for sovereign debt itself? And the answer is no, at least not the same way, because there's no market price for Greece. We don't have, I mean, that is actually the problem. The drachma is frozen, so we can't see the value of the Greek economy in any kind of a market price. So you'd have to do the analysis the same way a bank regulator would have to. They'd have to go in and look at the assets and liabilities and future revenue expectations and costs and see what's like. We haven't done that.
Another question?
But we do have the price of bonds for the bonds discounts.
We need people to speak at the microphone because it's also being recorded.
Just some comment and then a question. We do have the price of the bonds of this market, so it could, one problem is that if the regulator, I think it's hard because if the regulator use your data, say to regulate more, that'd be like self-fulfilling accounting, right? Because it asks more capital from banks if they have problems on they do not trusting the government, they're going to be rescuing these accounting and that, so it's more complicated.
The regulator is showing the position.
You're right. You mean a regulator that said to Greece, okay, would you please increase your capital? Greece is going to say, sorry, I'm doing my best. But of course that's the reason for this countercyclical issue even for banks, because you can tell a bank to raise capital, but if it's on the edge of bankruptcy, there's no way for it to do that. It's really, at that point, it's a very difficult situation. So in fact, at that point, you probably want to tell it, you don't need as much capital. Try to save yourself without worrying about regulatory standards. And that's what this countercyclical policy would be more likely to do.
Another question?
See in the back there? Yes. But there's a microphone. Can you raise your hand if you're... No, I was hugging. No, Anybody else want to wave? So is there anybody here that's a regulator?
Professor Luis Braga, our graduate school of economics.
So you're proposing a methodology that basically you should take market prices to infer when the next crash will come. So market prices usually reflect information that are on the table, are available for everybody. So it looks like that you only predict a crisis when it comes. If you see a crisis as a structural break and not a process that is periodic and stationary. So I'd like to see your view on that.
Well, I don't think it's as bad as you'll predict a crisis when it comes. But when you look at because see, what we're doing is we're asking not only what is the value of this firm today according to the investors. We're asking now, if there's a financial crisis, what would the value of this firm be? And that's a question investors don't have to ask in deciding whether to hold the stock today. So I think, let me turn your question a different way before you re-ask it. People often ask, do investors care about this list? In fact, do the companies that are on the list care that they're on the list? And so my answer is, investors might care about this list for two different reasons. One is, they might say, I am very worried about a financial crisis, and therefore I don't want to hold stocks that are going to do badly in a financial crisis. Therefore, I would underweight these 10 or however many companies. They might also take the opposite point of view. They might say, these companies are going to be bailed out if we have a financial crisis. So if we have a financial crisis, these are the companies I want to own, not the ones that are going to go, that are not going to be bailed out. So if you really think they're too big to fail, then you might want to overweight these firms. I don't think either of those issues affects the valuation today, or at least not very much. If given that the conditioning event is a very, a major change from where we are today. I think there's a follow-up that I'm going to get here.
But my point was that even though you are doing like a structural change or some change on the, so you basically say, well, if there's a crisis, and then you have to define what a crisis is. This is the part that. But then you still keep the whole correlation structure of the economy as if it was given by the data that you have prior to the crisis, right? So in some sense, you're still praying that the world will be as it was before the crisis, so that.
Okay. Yes, and no. So the question is, are the parameters of these models stable through the crisis? The parameters are not the volatilities or the correlations. They're the parameters for the updating of the volatilities and correlations. So we're allowing correlations to change and volatilities to change, but we're assuming that the process of that change stays the same. So, and when we do the simulation, we get the outcomes where this process turns the worst. In other words, when we look at the outcomes where the market collapses the most, these are outcomes where volatility spikes up and where correlations increase. So we're looking at specific scenarios, which are the worst case scenarios. So we've done some work as to whether the parameters of the volatility process changed during the financial crisis. We haven't done the same thing for correlation process. And what? Jumps in correlations.
And I think this thinking about it, like the whole structure is going to change, specifically for the correlation.
So maybe, there is a view which is that a crisis doesn't look like anything else, but then the question is, what's the meta model into which the crisis does fit? And you might say, well, maybe these parameters aren't going to be constant, in which case let's talk about how they change and what would change them. What are the inputs to these processes that give us a way of forecasting the future?
I understand, but I still think that your methodology is very good for as a scrutiny. Like you can look at these companies and then decide if you want to change, like control them more, even though you know that it's not perfect in terms of the parameters. So still you have information right at the beginning of something happening. I think that's the idea.
That's the idea, right? You would like early warning for what's going on as soon as at least the financial markets see something.
So let me disagree on that. So that just to have some in the big here. So let's say that there are two banks, and one of them is doing something that you consider very risky given the current structure of the economy. And Kyle's bank is doing safe strategies. And then you will put a lot of regulation on me, because on your view I'm doing. So, but based on some view that I have on what's going to happen to the economy, if what we're calling a crisis here comes, I believe my strategy is safer than his strategy, because, and then you put in regulation on me, and I'm telling you, no, you should look at him. What looks safe to us in normal days might be very risky in the rainy days. That's my point.
So I would say those two banks are probably not going to look the same to investors. Investors value these banks. It's really investors' decisions that produce volatility in the equity prices for these institutions and produce correlations in the returns of the banks and the financial markets as a whole. The regulation that you would put on these two institutions would therefore not be the same. It would be the same form, but it would have a different value. In other words, according to me, and actually I think the FSOC is thinking about it this way too, that if you have two different financial institutions, each of which you think has some systemic contribution, you would maybe regulate both of them, but you might not regulate them the same, in the sense that they would have no incentive to reduce their systemic risk. If you want them to have an incentive to reduce their systemic risk, then you've got to have a function as opposed to just a dummy variable for whether they're in or out. And this long-run MES is this kind of or S-risk is this kind of a dummy variable for, a function which tells you how to value the risks that each institution is taking. And it's not whether you think they're risky or not, it's whether the investors think they're risky. We've been told, just for example, we've been told that the financial industry shouldn't be treated, insurance industry shouldn't be treated the same way as financial institutions, because they have a much more stable cash flow and much lower risk. Turns out they have a lot of leverage too. And our response is, well, that shows up in the way equity holders value these insurance companies, and lo and behold, they have a pretty high beta. So they have a high beta because investors think that when the market is going down, it's going to hurt the insurance companies, and their leverage is going to be a problem. So it's not just whether you say you have a stable stream, it's whether the investment community, whether investors value it that way.
Well, after this meeting, we are going to have the press. There are some people here from the press talk to Professor Engle. Based on this fact, they are probably going to address some questions to the Brazilian situation. Based on this fact and taking on the things you said about Brazil, I'd just like to make one brief comment. It's true that our regulators have done very well. That's one of the good things that we have inherited from periods of high inflation. We had so many disadvantages, but we should have learned something, and we did. However, there are some evidence that we should be very concerned, and we are in this school. We don't have the answers, but we are doing studies about the state credit, or the statization, the credit. So, for instance, I give you some statistics. We have had from 2008 to nowadays an increase of external savings. They are nowadays around $50 to $60 billion per year. And that has led to an increase of our net external liabilities from 600 billion to around 730 billion dollars. Okay, it would be okay if we were increasing our capital stock at a pace consistent with this capture of external savings. But the problem is that that has not been happening. So the allocation of external savings that we have is not keeping pace with the increase of investments. And what has been happening is that, for instance, external savings rose from approximately to 0 to 2.5 to GDP in the last 2 years, and the amount of investments in 2008 was 19.1% of GDP, and nowadays it's 18.4. So you have a 2.5 increase of external savings at the same time that you have a decrease of formation of capital, which is to say that we are consuming more and internal savings are falling. So this shows that although there has been a good regulatory system, we should be very much concerned and study this, the fact that a great share of our savings is being conducted by the state. We all know that the state bank, the BNDES, has nowadays around $200 billion that has been assets issued by the government to be sent to the bank without passing the control of the legislative. And another evidence, we started a sovereign fund, and this sovereign fund, which was supposed to somehow work as a buffer to the fact that we have discovered some non-renewable natural resources, this foreign fund has applied most of its resources in 2 state companies, not abroad, but it's 2 state companies. Around 75% of our sovereign fund is applied in shares of Petrobras, and around 10% in share of Banco do Brasil. Since Petrobras and Banco do Brasil have done very badly in the last 6 months, the foreign fund, the sovereign fund, has decreased its net worth from 19 billion reais to around 14 billion reais. So we lost 5 billion reais of this fund. So I think we all should be very much concerned, and maybe the press could address questions to Professor Engle, not only regarding the regulation of the private sector, but also regarding the fact that most, if not almost all, of our savings dedicated to long-run investments are channeled through the government. And the data shows, given the 2 statistics that I have given to you, shows that we are not doing as well as we could do. So is that this is certainly something that we should be studying, and I'd like to say that at the Graduate School of Economics we do have people studying that, and we may come out with some results very soon, quantitative results about the allocation of savings through the state, and how good or how bad that has been to our country. So this is. So any more questions? Please.
My name is Julia. I'm from Sinolad Investment, and I want to ask you, would it be reasonable to apply this model in a country super regulated such as China?
We are doing that, but we're very nervous about it. The question is, what interpretation do we give to measures like systemic risk in a country like China? Basically, it seems to me, Chinese banks have an infinite backstop, practically, in the government is willing, and they're basically state-owned financial institutions. So the idea of seeing a financial institution go bankrupt in China seems pretty remote. That being said, according to the statistics that we have, the amount of capital, the amount of debt that Chinese banks have seems to be not very large compared to the amount of capital they have. So I don't know whether those statistics are believable or not. That's one of the things we're trying to understand, because there is the recent anecdotal evidence that in fact a lot of these financial institutions in China have massive loans to municipal governments that are unlikely to be paid back. So it's a big issue, I think.
Okay, so we are running out of time. I'd like to thank all the participants. I was advised by our public relations department that I should keep Professor Engle and the press in this room. And I'd like to invite all the other participants for our coffee break. Thank you very much.